So apologies if I go out of screen sometimes here during the presentation. Today I would like to give you an update. So I assume you are familiar with the fund and what I'm doing and what we have been doing before. So this is more an update for the period we have seen over the last couple of months, basically. And I've talked probably to some of you since then as well, and there might be some slides here that you are familiar with. The agenda today is just go through listed real estate, the implication of that we have seen. As far as I understand it, it's a lot of parameters out there now that is very hard to grasp, as you know, but I will try to give you my view of it. Short fund up view, a brief update on some holdings that we have taken during this volatility, and a brief outlook. And then hopefully we will have some time to go through some questions after that. This is a picture, or this is the reality we are all living in at the moment. Big questions, what will happen tomorrow, but probably more important, what will happen down the road, half a year, 1 year, 2 years from now. How will this that we are experiencing fall out, and what can we do about it today, tomorrow, and next year? Obviously, nobody has the answer of this, so we have to rely on everyday today information and try to do our best with that. So in my case, running this SKAGEN M2 portfolio and within the global real estate space, I have decided to go on as I normally do, because I think that's the right thing to do, and I will elaborate a little bit more on that down the pages here. But the thing is here, stick to what you know and try to do the best of it. That's actually the message, and thing will probably get more clear along the way here, because nobody knows the answer of everything today, and the ones doing that are lying. First of all, as a reminder of why global listed real estate is a good place to be. You have seen this page before, and it's still valid, especially in the long term. But some of the implications short and mid-term, or some of the points or characteristics outlined here on this page, are more important than ever, I would say. For instance, the inflation protection part. Nobody knows what all these stimulus packages from governments and central banks will lead to. Will it lead to inflation or not? But still, real estate are providing a protection and has done so historically against inflation, or all real assets has actually. But this might turn up to be a deflationary environment with no growth and very low or non-interest rates, more like Japan. That is also a okay environment for real assets. Growth component should be there in the best of the worlds, but still, it's not a very bad thing to have for real assets anyway. Diversification, more important than ever. We have seen that in terms of geographies, but more importantly in terms of segments, where we have seen some real estate segments going really down the drain, and some of them have actually held up and are even better off than some months ago. So that is very important. The long-term value drivers are still there, but they're also here as we speak. I'm thinking of data center, for instance. I'm thinking of towers and those kind of sub-segments that are actually experiencing the mega trends as we speak. I'm thinking of also the diversified investment universe. This is a global real estate fund, and I can invest in different sub-segments, but also different geographies. Very important in these days. If you want to have the real estate exposure, you should not be exposed to one real estate cycle, even though there are very many moving parts today, and they are global in a sense, of course, but you should also think about the real estate cycles here coming out of this. Liquidity, maybe the most important parameter here. We are seeing it now, especially in the UK, where a lot of this open-ended fund has closed down. And interestingly enough, we have seen it before. We saw it post-Brexit. We saw it the grand financial crisis. We see it now again, where investors are stuck with the money in closed products. They will not get their money today, probably not tomorrow, and they will not get what they had hoped for, because when transaction market is drying out, this will get really nasty, because you will have to sell many of these assets at fire sales, basically. I have also sold at very low levels during this crisis, but at least I get some of the money back, or most of the money back. Not what I had hoped for, but still my investors get the money back. And we have a very good liquidity profile in the portfolios as of now, so that is not a very big problem. But sooner or later, investors will start to appreciate the liquidity part more than the volatility part, or a mix of it anyway. I think also it's time to appreciate the flexibility that we have in this fund in terms of geography and the subsegments. Because as I have stated before, this is not only frustrating times, it's also times for a lot of opportunities, especially going out of this and with a little bit more information along the way, and how things are evolving. So I think we have done some good purchase the last couple of months in terms of new holdings, addressing this flexibility. Sorry for that. I thought I put it off. Next part I want to show you is how have real estate done it in terms of performance. So the light blue graph here is MSCI all country, meaning all sectors. It has returned minus 18% in euros up till yesterday. The green bar, or the line, is MSCI all country real estate, i.e. our benchmark has returned at minus 25%, so 7% less. Next two lines here are the US real estate market. The listed real estate market has returned minus 22%, and the European listed real estate market has returned minus 28%. So a very quick conclusion here is that real estate has come worse out than all the other sectors, not all sectors, but many other sectors. And US real estate has performed better than European real estate so far. And this is also visible in this slide, where you have on top healthcare, and third from bottom you have real estate returning minus 25%. This is strange in a way, because if you look at listed real estate, bless you, if you look at listed real estate, traditionally in corrections or downturns, it has a defensive characteristic. Why isn't that today? I will try to exemplify this by this graph. It's illustrative and it's Swedish real estate market listed, and the Swedish OMX index, i.e. all the other sectors. It's pretty much the same in many other markets as well, or the trend is the same anyway. Starting out with the dot-com bubble at the beginning of the graph, real estate were very much defensive, and this is maximum drawdown at the corrections. Moving over to Lehman, real estate were also defensive, a little bit more in Sweden, where we didn't have this big financial crisis as for instance in the US, but still it held up pretty well. Moving over to when Fed were rewinding their quantitative easing, there were a small correction or somewhere in the market. Real estate were again defensive against all the other segments or the broad index. Also, we had the European debt crisis. We saw the same pattern. We saw the same pattern in autumn 2018 when we had this worry for the economical growth in the world. Smaller correction, but still real estate defensive. And now exemplified by a globe that is locked with the lockdown, the corona crisis. We have seen another pattern. Why is that? Because typically what you saw on page 1 is real estate has long leasing contract. That's the most characteristic from this. So it shouldn't get affected because leases are, let's say, 3-5 years. So nothing should happen during that time. It's just go on. Except from when tenants are going bust. And this is what market obviously are afraid of. We have also seen one of the reasons that, for instance, in the US, but also in Sweden for that sake, real estate were among the best sectors all over all segments and asset classes last year. In Sweden, for instance, real estate stocks returned 60%. So it's easy to take the profit when things are starting to fall. That is one component. The other component was the signal, or it was very obvious that shopping malls and hotels, they will lose their top line, most of it anyway, very quickly when markets or countries are closing down. The third important component here is that real estate is a capital-intensive asset class, as you know, and investors started to extrapolate this. If they don't have any top line and they have to refinance their debts or get more liquidity, this might end up in trouble if you can't sell or dispose anything. The dry up of the transaction market, as I referred to before, that we have seen in other crises. So this obviously has created together all these components, a cocktail for a big sell-off in real estate. But we're not out of this yet, so we don't know the end of this. And real estate has rebounded somewhat the last couple of weeks, especially in the US. So this is just a graph showing the best and worst market. The worst market year to date is Australia, down 40%. The best market is Hong Kong on the right side. It's only down 15%, but please keep in mind Hong Kong started to get their share in June last year due to the social unrest, which actually was taken over by the corona outbreak in December in Hong Kong. So they have had their share of a downturn in Hong Kong. So there are geographical differences, but it's pretty synchronized anyway of what we're seeing. And please also remember that Europe were earlier in this crisis than US, for instance. And I don't know when we're getting out of this, but we should probably get out earlier than the US anyway. So it's important to bear in mind. Different segments is important. This is a graph from the US, also from this from 21st of February, where actually the start date for this turmoil started, according to many people anyway, and I think it's a fair date. So here you see, if you look at the whole bar, it's divided between equity value and enterprise value. They're breaking it up since the depth of a company has bearing of the stock market performance. Should be so anyway. So if you look at the right side, malls is down about 60% in average. And lodging, it's hotel basically. They have also slided it up here in small subsegments. On the left side, it's very interesting. Here we have data center and towers that I have been referring to before, and they're actually above already this point. And we have seen companies in these subsegments having all-time high notes, and they have performed very well. Also reflecting over the Netflix numbers coming out yesterday evening with almost 16 million new subscribers in first quarter, double from what the analysts had expected. This is driving data center to make it a little bit more tangible. So what is the thing everybody's thinking of here? Well, it's the rental collections. And this is where it starts to get hard, because all the countries has different collection norms, but not only the countries, also the subsegments. For instance, hotel has 1 day, and you have some other government leases, 15 years and so forth. So there are a variety of options here. But we have seen now in Sweden reports for first quarter start to roll in. Sweden is traditionally early in the global reporting. And there we have seen almost 95% rental collection for second quarter. But this is typically for Swedish market, but also some other markets. It's 3-month prepayment. So actually first quarter was paid already 1st of January this year. And second quarter is paid now. So that's good numbers. We have seen UK numbers fairly well. We have seen US number fairly well. But then the difficulty starts because you have to look at the segments as well. We have seen in both UK and US rental collection for April has been as low as 20 to 25% in malls, obviously because they are locked down. But some are still paying anyway, according to the contracts. We have seen good numbers in rental housing, basically all markets. On the left side here, you have a graph from the US Society of North American REIT Society. Came out today, and there is a rental collection for April in average on the big picture. So it's very, very big differences here. And on the right side, this is actually where it starts to happening things now with deferred rental payment, rental holiday, or even free rentals. You have also states or governments that are supporting some of the rentals, not 100%, but still they are pitching in money to support different sectors. But you can't save everyone, that's for sure. So what is happening now is that tenants and landlords are starting to try to survive, to be honest, on both sides, where actually this crisis is a little bit different because tenants are more strong now because it's more supported from the society. Again, this will not flood through all real estate segments or companies, but majority of them has some sort of discussions already coming through. So here is the here is really important to be selective on which segment and company you are looking at. Again, back to my thesis about defensive growth. No company are more or less immune, but there are worse or better cases. So typically in a situation like this or in a downturn, you have those discussions that will come, but I think this time it will get a little bit worse for the landlords than, for instance, in the financial crisis. So I spent a lot of time to think about different outcomes from this in a real estate perspective, and I've talked about before the intersection between structural changes and where we are now, because this will affect real estate as it will affect most other parts of the economy in one way or another. And then I thought about the office part we have seen for the last 2 decades a densification of the office square meter or square feet, meaning more people on less or the same area, basically. This has also been the foundation for increased square meter rents that we have seen in capital cities that has gone through the roof sometimes. So basically, if you take it by square feet or square worker, it has been pretty decent numbers, even though the absolute dollar per square meter has been elevated. So densification in US, for instance, has gone from 200 workers a square feet to 283 workers a square feet over the last 2 decades. Will this last with this virus? Will we start to think about, oh, maybe it's not a good idea to work 2.83 persons in a square meter? Maybe we will, or what it is, maybe we will work less people in the office. We have to put more capex. We have to have good filters in the air conditions. We have to have other safety measures coming out from diverse correct or situations like this. We have also realized that it's okay to work from home. It's not okay probably over time, all the time, but if some of the employees are working from home a couple of days in a month or maybe a week, we don't have to have this size of the office. Maybe it's not necessary to have this expensive office in the downtown or high street. That will also change, I think, a little bit. We have the co-working that has been the rising star for many, many years, and I've been talking about WeWork for a long time as a problematic company. Not the concept, not the idea, even though the concept as of today, in the situation we are in today, are not the best idea, with many people gathering in small spaces to have small intimate meetings, more or less. But it has been a very popular thing for entrepreneurial firms and young people. So I think that concept will still survive. But the problem is, if you look at WeWork, for instance, they have 15 years of lease commitments to the landlords that we can find in many cities today, the big names. But their tenants, their clients, do have 15-month in average lease length. So this mismatch between 15 months and 15 years are huge, especially if you're a company with no assets and a pile of debt and an owner that doesn't want to pitch in more money into the company. So that will change, probably go over more to the traditional landlords, and they have their own small brands for co-working. That is one big change. Logistic warehousing looks a little bit more positive, I think. People today talk about deglobalization in a massive scale. I'm not sure it will be that massive as we have seen many projections about, but definitely what I'm sure about is that clients will demand better or more stock to be able to weather storms like this. They will also demand some local production, or the companies themselves, to not be so dependent of global supply chains. We will also probably see new clients in terms of hospitals, military, and so forth. I've heard indications of this, because they want to have this readiness, or the stock for masks and things like that we didn't have in Sweden, for instance, but we are obliged to build up with that now. And obviously the strength of e-commerce will be much, much stronger due to this crisis, because people that hasn't used internet for shopping or shopping groceries, for instance, they have gotten used to it now because they have done it for the first time. Also in emerging markets, we have seen such an effect. So this will actually accelerate the e-commerce trend that we have seen. And I think the grocery part is interesting, where you have UK at 8% today, US 3% of all groceries are traded online or shopped online. Germany is as low as 1%, together with Spain 1%. So there are a lot of headroom there to increase that part. And that will boost, of course, also the next part here, data center towers. We have a short-term effect by sitting here and working out together, but also the Netflix, etc., etc. But the longer trend here is that companies actually realize we don't have enough capacity to host situations like this, and they will continue to accelerate the mall usage, because the underlying trend, even pre-corona, is of course very, very strong of cloud usage, or the mobile data increase that we're seeing exponentially still. So this is a part, and you can also see that in the valuation of those companies and why they have succeeded better than others in this crisis. Hospitality, well, it's too early to say. I think we will see different patterns there. Business traveling, maybe not that much as before. It will take some time anyway. Holidays at home, less flights, also pushed by sustainability trend, and work from home trend, of course. And shopping malls, evidently on the other flip side of the coin of the e-commerce trend. There are probably a lot more, but I think within these that I have outlined here, there are opportunities, but also threats. And I like to dig down in this. It's too early to say, but some are more obvious than others. But here you can find really interesting parts in my segment. Okay, you have seen this before. Over to the fund performance. This is as of yesterday in euros, net of fees. Year to date, we're struggling a little bit, not that bad, but seeing to the performance in the US and seeing to our relative underweight from benchmark, it could have been a lot worse if you put it like that. Long-term performance still very stellar, and that is what we are actually aiming at, long-term good risk-adjusted performance. So it's about 5% net of fees since inception annually. The reason for the underperformance, as I said, if you want to dig down deeper in this, is allocation over under allocation and currency. We have a small part stock picking here is the green bars, the light blue is the allocation effect, and the dark blue is currency effect. And this is obviously things that are a little bit hard to foresee how currencies are moving and so forth. But obviously our underweight in US has hurt us on the relative terms. Also the stock picking in US has been bad. Sweden hasn't been good year to date, but was very good last year. There are explanation of this on this page. The funny side in here on the left side is the absolute return, in positive absolute return. Here we clearly see what I've been referring to. Equinix is the US data center company, has returned a lot. It's almost 8% in the portfolio now, so it has weighted itself up a lot. Second good best company is a new holding, Equity Commonwealth. I will touch upon that later. Same as Azura, it's a British company within healthcare. I will also talk about that. ESR Cayman is a new company for the year, but we bought it early this year, and it's logistics. It's a pan-Asian logistic platform and developer. And Switch is also a new holding that I will talk about. Now over to the less pleasant side. It's on the right side. It's Colony Capital. We bought into that in September, October last year. It was a company that were in transition. We knew about the risks because they held healthcare, hospitality, and logistics, and they were transitioned themselves to digital real estate or tech real estate. They held a platform of that already, but should accelerate that. They sold out the logistic part to Blackstone, a very good price tag, and they were about to sell the healthcare and hospitality. Then came Corona. And sitting with a large hospitality portfolio wasn't the best at the time where nobody actually visited the hotels. So we sold out that, unfortunately at pretty low levels, but better to be safe than sorry. And it's still extremely volatile, and the jury is still out there of that company. Around town, it's a good company. It's very solid and very well capitalized, long leases, but they hold 20% of the portfolio is hospitality in Europe mainly. They also hold office and residential, so it's a diversified portfolio. Vici is the same basically as the hospitality, or it is hospitality. It's the experiential. In this part, it's the real estate for a lot of the gaming industry. It was also locked down in the US with you can imagine what's happened with the stock price then. The operators, the gaming operators, are very well capitalized. We have done a thorough research on that, and they have liquidity for a long time. But still, the initial effect was it was bad. Adapteo was bought earlier this year. I thought it was basically Corona safe, or it was a stable defensive growth stock, and it is. Problem here is they are renting and selling modular houses for daycare, schools, and elderly care. Typically, their peak season is end of Q1, beginning of Q2, when they are negotiating the contracts with governments, and that's the bulk of their rental income. And the rents are basically 5 years, so it's stable and secure rental income. Problem now is that the government, especially in Sweden, Norway, and Scandinavian countries, they were occupied with other things than negotiating this contract in the burning corona crisis. So actually those negotiations were postponed. And these are really important times of the year, because they will roll out all these modules during the year or in summertime when the kids are out of schools, for instance. So this is loss of growth instead of loss of or any problems in running business, because these leasing contracts are safe, I would say, because I have a hard time to think the government really tried to renegotiate them at this time of the crisis. So they are really stable, but the growth were actually off the table. So it was a very, very bad time decision. I admit that, but who knew about Corona? Still a very interesting company, has become very cheap. It's trading about 10 times EV/EBITDA and has a cash flow yield this year of 10%. They can draw down the capex, which they have done to save up some of the liquidity, but they have very good cash flow profile. Stendörren is a Swedish logistic name. High debt. The interesting part of the leasing contracts is further down the road. So when I took in Adapteo, which is a Finnish company but listed in Sweden, I sold out Stendörren due to a high risk profile. So that's the reason behind that. This is the same attribution, but over a year. And here you can see Sweden, rental apartments, data center, and logistics has been very good performance. Rest on the right side, you see some of the same names as the slide before, except from Brookdale, also a name we bought into in this autumn. Senior housing in combination with Corona crisis is not a good thing, especially occupancy is declining, and they are taking on a lot more cost due to all the safety regulations and security measures they have to do. Columbia Property Trust, we sold down to take down the overall office exposure to US, since we hold asset green. What we have done instead is to go for these resilient segments that we have been doing before. Residential real estate, for instance, self-storage, healthcare, social infrastructure, that is basically Adapteo, as I told you about, digital infrastructure, and logistic and warehouse. These are the more resilient segments. For those of you who have listened to me before, know that this is not a new thing. We have been investing in these segments a long time due to these reasons, as I have referred to. What we have sold out is hospitality. We held Phoenix Mills in India. We sold it out before the lockdown of India, which was a good thing. We also sold down SM Prime, mainly shopping malls in Philippines, but also in China, also at okay levels. We have also taken out most of our hospitality, i.e. hotels. We still have some both retail and hotels in the diversified companies like Around Town or Mitsui Fudosan Japan, for instance, but they have many more legs to stand on. We have also taken out the more stretched companies in terms of balance sheet, because I think this will be a divider between performance and non-performance. It has been that, but it will be even more important going forward. If the liquidity is draining, both in terms of disposal, but the credit availability, that is probably not the biggest risk, credit availability, since both the governments and central banks provides the market and with liquidity, but it doesn't always help the companies themselves. So let's see what's happened on that side. But we have a very good debt profile in our portfolio, I would say. Interestingly enough, just a year ago, it was rewarded at the stock market, or even half a year ago, rewarded with high debt in this segment because of the high return on equity or high cash flow yield. So things are changing. This is what we have done since mid-February until now. This is active management we're doing, so we have been very active. 3 new names in, 8 names out due to the reasons that I have told you about. We have reduced some names out of the same reasons, and increased in some other names that we have as convictions, or they are in the right segments or have the right balance sheet. This has also changed a little bit. You don't find that much hospitality nor retail. Majority is industrial logistic, residential rental, and office still some. And you have some of these in the diversified names as well. This is interesting. You can see clearly here our underweight against the US, and again, it's not because I don't like US. We're coming from a very stretched valuation in the US pre-crisis, and it has become also since the rebound, some of the names I don't see that justified, to be honest, in terms of balance sheet. And we don't know the outcome yet of the rental collection. So the question here is what is priced in or not. And in some cases, I would say they have priced in too much in relation to the underlying fundamentals. Because what we have seen now last couple of weeks, if you take a generalist view, cash flow multiples has been adjusted down 5 to 10%. Also, the valuation of the companies, i.e. the net asset value, has been taken down from analysts. If I generalize it, also 5 to 10%. And we are still very early in this year to make that assessment, I would say. And the polarization here is enormous. I mean, retail companies are taking a lot of hits, while data center estimates are going up. So there are a wide spread here. A good balance in the different market caps. You have seen the top 10 names before. No big change there. I stick to what I believe in and the proven cases. So it's basically rental apartments, data center, self-storage, and some healthcare. This is important. We try to update this every time we talk to you clients. Loan to value is 37%. This will be very interesting parameters to track in our industry, since the V is going down in most cases. For sure, there will be a revaluation downwards in many cases, and the reason for many funds has closed down is that they can't put a value on many retail assets, for instance. So the V is interesting, and that will also lead to some companies will breach their covenants. And if they breach their covenants, they will have a problem with the banks or the bond market, even to get liquidity, but also in terms of very much higher interest rates. Net gearing is 70%. I'm very fine with that. Also, interest coverage ratio and is a good number. Here it has come down a little bit due to weightings. For instance, some of the most resilient names has lower interest rate coverage, but it's more secure leasing contracts, and they have been weighted up in the portfolio. Equinix, an example, with very, very long lease contracts, riding a very, very strong trend. The bar on the right side is the spread to 10-year government bonds or risk-free interest rate. It has come up due to the interest rates in most countries has come down, but it's still a very good number. Valuation of the portfolio, this is also updated. We are well below benchmark in terms of valuation multiples. EV/EBITDA, price book, but also in terms of debt profile, where we are well below index, if that is a good measure. But anyway, this is an illustration. The only thing we are not as good as index is the yield, the dividend yield, but that is perfectly right, and it's a part of our strategy, investing in value-added companies that are recycling their earnings into the business instead of handing it out as dividend and then go raising equity after that, because that is a stupid thing to do. We have on the other hand a higher earnings yield than the benchmark. And speaking about raising capital, there will be a lot of capital raise going forward. Some of the companies has already started to do it. One of our new holdings did it 2 weeks ago. I think that's very prudent to raise at strength instead of the opposite, to raise capital at panic, because it will hurt you and it will be very bad. Also, since I'm almost sure that many will raise capital going down the road, you don't want to be the last in line, because it's exhausting the investors, and money isn't. I mean, it's not an endable resource. So that we will see going forward as well. We have also seen a lot of dividend yields has been postponed. Also share buybacks, mixed pictures. Some has actually started to buy buyback shares, those with a lot of money, and some has postponed it. So we will see more of that going down the road. We talked about liquidity before. Over 80% of the portfolio can be sold out within 5 days, and that's very strong. We have a couple of names that are illiquid, typically sold via block trade. We did that with Stendören, by the way. So we sold everything at once at okay levels. Talking about the liquidity in the fund, we are very happy that we have net subscription so far this year, both months to date, year to date, and last year, of course. And we are very grateful of that, both from our clients and the people within the organization that you are meeting that have done a very good job on that one. In times like this, it's a very, very strong, it's a strength sign, I would say, that the clients believe in what we're doing. You all remember this, you have seen it before, but it's an important picture. You have the mega trends on the top, driving different sub-segments in either direction, and creates trends in the economy. But we are looking at companies within those trends, and they might change. One of the trends that you're missing now is the hospitality or experiential trend that we have put on hold a little bit. I think that's wise. And put another one, maybe not, it's a trend, but it's not as evident as all the others. But still, I find that a very interesting trend that always are underlying in what we're doing, but I think it's amplified now in terms of the opportunities that are arising. So that moves us forward to the new names that we have, and I will go through this fast because I see I have taken some time. Digital infrastructure, healthcare, real estate, and optimistic. Switch is the one of the newest holdings. It's a US-based data center, was founded in 2000, IPO'd in 2017. They have 4 campuses, or campuses in the US, because it's mainly a US-based company. They're among the smallest in the data center among the peers, but they have among the largest facilities. Their strategy is basically to operate in growing tier 2 cities in the States with low tax, 100% renewable energy. In this case, it's sun, so they have solar panel, all renewable, very cheap connections, but also it should be low risk of natural disasters. So this is basically their pitch. Triggers for this company is obviously growth, but it's also large leasing contracts, hyperscale companies that are moving adjacent to them or at their campuses. So they're having an edge in what you're doing in specialized area of data center. We bought it at good levels, discounted levels among versus the peers. Unfortunately, it moved away from us a little bit. It wasn't due to us, but it became a little bit expensive. So we have a small position, but still it's interesting, and we wait where we are now. So interesting company. Next one, it's a perfect SKAGEN emot name. It's a British healthcare name. It's a REIT with 576 properties. The strategy here is to develop, invest and manage healthcare properties throughout the UK. They have a very strong balance sheet, and this was the company I mentioned, raising 10% of the equity for pipeline, but also acquisitions potentially. And I think it's very wise to do that now, because we will see fire sales, we will see distressed or mismanaged assets coming out to the market, especially from these funds. So I think it's a very good idea to raise capital. So we participated also at good level. It was 10% discount. I was a little bit surprised, because this is a high quality name that we have been waiting for a while. They have a pipeline, so it's really defensive growth. 10 years down the road, they are sufficient with their pipeline, and they have a very good track record of developing over 8% development yield, with a very good track record of creating shareholder value. They are reimbursed by national healthcare NHS in UK. And they have a model of reimbursement, the leasing from NHS, and this model has been working for 70 years in the UK. So typically in this type of companies you have a political risk, but this company is trading in line with the European peers, but much below the US peers. And I would say the political risk in UK is lower than the US within this area, but also pushed by a very strong underlying trend of aging population that you have in UK, as you have in most other places. So there will be more clients coming over time. So I think this is a really interesting company. Third new holding is a little bit special. This company is Equity Commonwealth, is basically a product of a hostile takeover taking place in the US 2014. It was the legendary real estate billionaire Sam Zell that founded the Equity Group that holds stakes in lots of other real estate, that bought this company, and he put himself as chairman. And during this 6 years, they have been very, very active and aggressive of repositioning strategy, and also aggressive to sell out the asset. They have sold out about 163 assets in 69 transactions, leaving them with $3.3 billion in cash. And they are actually just waiting and looking for opportunities within the distressed situation, sellers or assets. Should not be hotel retail, it should be fundamentally strong locations, fundamentally strong subsegments. And they will not invest in rental apartments either, because the group holds that already. So if you start to calculate on this, they hold $3.3 billion in cash, which means almost $28 a share, and the share is today trading at $33.2. So it's almost the market cap, not exactly, but almost. They have still 5 assets that are very low. They are actually in the books depreciated. So this is equivalent to a yield of 33%. But if you fair value this, we end up in a target price well above today's market cap. So this is a proxy for cash, because they're holding cash, but with a huge option in times like this. Actually, I know that he has been waiting for the crash of WeWork and the consequences of that before he will deploy some of the cash. Let's see what's happening, but I think it's an interesting option to have. And if by any reason they don't find anything to buy, they can always hand out special dividend, and you still have the 5 assets running with 90% occupancy, but that can also be better or worse. So this is an interesting company. So I think it has a good place in the portfolio. Okay, this part is very uncertain, and I've written that in the headline. What's this next? Well, we know about the potential decrease in asset values, especially in some segments that are struggling, and also in other segments. But will this only last this year, or will it spill over to next year? Well, I'm not sure about this is only capped for this year. I think it will also affect next year, the valuation anyway, because it always has a mismatch in time. As we have talked about, on the upside it's lagging, and now it's also lagging on the downside. But the cash flow is more uncertain. This will definitely be hurt this year in many sub-segments, but not in all. So that's the bad part. Depends on how long this will go on, of course. I think there will also be a lot of companies going out of business. I'm sure we will not have as many retail companies as we see today within a year, that's for sure. Many of them will not handle debt situation, but they would probably have gone out anyway sooner or later. We will see more of the M&A, we'll see more equity raising, we'll see more higher debt, higher cost of debt. And that's the bad part. The good part is this is a long-term asset class. There are definitely growth along the road going forward. There are definitely many opportunities out there, and I think we as active managers are in a good position to find those opportunities. And hopefully this situation will not last for much more longer, but we will see obviously a hit on earnings, and even though we have long contracts in these sub-segments. But as is today, it's 5 to 10% on earnings, it's 5 to 10% on valuation, so total return overall is negative. But on the other hand, recovery will come sooner or later, and it's good to be positioned, because we are not at the there are some room in terms of valuation, in terms of many of these companies that are has been too hit today. I'm still cautious. I have about 4 to 5% in cash, because I think there might arise even more occasions due to volatility. So I'm open for questions, or if you are tired to listen to me. But if you have any questions, please.
Thank you very much, Mikael. I am now opening the microphones, so you're unmuted, and also remind you that you have opportunity to text your questions within the chat function at the bottom left. Are there any questions? No. All right. I would just like to say that I'm preparing the recordings from this meeting. So if you want to see it again, you'll have the opportunity quite soon. Thank you all for joining us today, and thank you very much, Mikael.
Thank you very much for taking your time.